I don't know whether I drew the short straw. I was lucky or late. I don't know what it was to be the first presenter on the inaugural Urbana Day, but I'm very happy to be here today and looking forward to sharing with all of you the Highview story. Okay, so we're located out in Oakville. We're actually registered as a portfolio management firm, but our focus, as Liz said, is really focused around the high net worth segment as well as some select foundations. And we've positioned ourselves strategically, more of a US concept, but as an outsourced chief investment officer, which I'll talk a little bit more about in a few minutes. But it's something that's really served us quite well over the past decade as we've been building and growing our company. The business was started by myself and Gary Brent back in 2005. For the first probably 5 or 6 years, we did a lot of asset consulting, given our backgrounds on Bay Street, with large families, some foundations, and some wealth management firms. And in 2010, we decided we wanted to get back to our roots of dealing directly with the high net worth families. And so we bought a small firm in Windsor, Ontario called Dan Hallett & Associates and rolled that into our firm. And the rest has sort of been history as we've continued to build this business. We're located out in Oakville, which is a great spot to be. I don't know if you've been there, but it's wonderful being down by the lake if you want to go for a walk, especially this time of year. We have a little bit under 20 employees, and 90% of our employees are actually equity owners today. We've been big believers of that since day one, and that will continue to be us for the years ahead. Urbana, as we all know, has been a key strategic capital partner of us for, I guess, about 8.5 years this past year. And everything that we do, and this is key, I'll talk a little bit more about it, but we do not have any proprietary money management. And what I mean by that, we don't have people in-house that are selecting stocks and bonds. That's not really what our core competency is. Our core competency we built up over the years has really been about constructing portfolios based upon the combination of specialized managers that operate in specific mandates. Another key feature for us is fee transparency. And again, when we started this business many years ago, a lot of the regulatory changes that had happened, like CRM2, for instance, where it forced fee transparency, at least from the advisory standpoint, was not in existence. And we just always felt that for the segment we're dealing with, you do need to really treat them like a business. If someone has a net worth of 10, 15, 20 million dollars, you have to look at their wealth as a mini wealth management business, and nobody runs a business without having transparency around fees and expenses. So it's really been ingrained in our culture from day one, and we continue to meet all the requirements, obviously, of CRM2, but we provide full accounting and transparency even beyond that to the families today, which they really, really appreciate. Business growth over this time period, we've consistently been kind of in the 15 to 20% plus a year, depending on the year. And it's been an interesting environment for us. It's obviously highly competitive, highly concentrated in Canada in terms of the wealth management firms, but we continue to just honestly see lots of potential with the growth. And I'll give you an example this year with all the chaos going on around the world this year. We're probably going to have one of the best years we've ever had in the history of the firm in terms of addition of new assets. So that's always positive. Just quickly on our client profile, we have roughly about 1.2 billion of assets. And again, it's focused on both the affluent family primarily. I would say probably 90-95% of our clients are wealthy families. They're entrepreneurs. And we only have about 240 families in total. But what's interesting is we have a lot of intergenerational wealth. We really spend a lot of time really getting to understand and work with the next generation. And so that's why we will have multiple households for a family. It's not uncommon for us to have 2 or 3 households, generations within a single family, which is fantastic from a servicing standpoint, but from a business perspective, it really does allow you to lock up those relationships so that as the generations pass on, it's not like you're necessarily put at risk of losing those assets down the road. Average net worth for us family, probably somewhere around $10 million. And the average portfolio size for us today is somewhere around $5 million. We have some clients below, we have some above. I always say we're really playing in kind of that investable portfolio size of kind of, call it 3 to 30 million, which is a really nice sweet spot in Canada. Another key point is the processes that I'll talk a little bit about that we have in place since inception of the firm really allow us to have a very high closing ratio up front. It's not uncommon for us to have somewhere around 70% plus of a closing ratio. So once we get in front of a new family as an opportunity, it might take us 3 to 6 months because we're running balance sheets, we're not running segments of portfolios. But we do end up getting those clients, those folks as clients typically most of the time. And then on top of that, through our service proposition and the way that we run money, which is a very steady, predictable place, we have somewhere around a 97-98% retention ratio over the past 10 to 12 years. So just quickly on a CIO, this is more of an outsourced CIO concept from the United States from probably about 10 years ago. And the concept is that if you're running a family office, you have $300, $400, $500 million down in the States, you're typically going to have enough assets so you can afford to hire your own in-house team. And when you bring those people in-house, what they're doing is they're actually employees and they're running the money for the family. But as an employer, they actually have a fiduciary obligation to put the family's interests first. And fiduciary, we promote it, it's on our website, we talk about it with families. We're obviously legally obligated as a portfolio manager to do it, but we actually promote it because a lot of large organizations in this country, they want to kind of shy away from the whole fiduciary standard, but we put it out there. And so the concept is that if you have $300 or $400 or $500 million, you can afford to hire your own team. But when you don't have that, what do you do when you got 10 million or 15 or 20? You can hire a firm like us on an outsourced basis to manage that for you. So we bring the same level of objectivity, transparency that a family office would have to a little bit lower high net worth segment. In terms of our process, this has been in existence from day one. Gary and I always had this philosophical belief that families that have spent, say, 15, 20 plus years building a company from scratch, they've typically had their payday, which can be many millions of dollars, and we're running everything that they have outside of maybe real estate assets and other business interests. And so they're not interested in a yo-yo ride. That's the last thing they want. They've taken their risk in life, and the last thing they want to do is to wake up and have to recreate their wealth at 75. So we focused on this concept of wealth sustainability. We were talking about sustainability back before it was really a big term in the industry these days. But the way that we do it is through these 3 processes that I'll walk you through today. But it's the integration of the stewardship, which is how we govern with the families and their advisors, the management of the wealth, the profiling process to be able to determine what's the right portfolio structure that's actually going to match the client's funding requirements over time, and with the objectivity of the asset management. And this has played out over the past decade for us. It's served our clients well and it's served the business well. So let's just talk briefly in terms of how we do the profiling process, because it's a really key part of what we do. First up, when we sit down with a family, we're going to have a bit of a discovery meeting. We're not pitching them on Highview that much. We'll obviously tell our philosophical beliefs and our principles, how we run it. But it's really sitting there listening and understanding the journey they've been on throughout their entrepreneurial life. And so a lot of times these families, they don't always understand or have had the time to sit down and articulate what the purpose of the money is, what the goals are. And so a lot of the conversations we're going through up front are really helping them to identify what those goals are. And from our experience, it really breaks down into 1 of 3 buckets for these types of families. You're either going to have funding for a lifestyle need, because again, a lot of them are now retired, and so they're not getting the cash flow coming from their company anymore. We are the firm that is providing with that cash flow from their portfolio. Or it could be, which has increasingly become a big conversation these days with these families, is family legacy. How much am I going to leave to my kids, my grandkids? And there's no right number, there's no right approach. It's got to be tailored for each family. But that is becoming a huge conversation. And again, it ties back to what I said up front, is that we are really big and focused on wrapping up the next couple of generations to have these sorts of conversations. And then finally, another thing that's starting to become big in Canada with these families in various ways is the whole philanthropic or social capital side. So the first meeting is really trying to understand at a very high level what their thoughts are around this. And then from there, if they're comfortable with what we're saying, we will then step back and then conduct a pretty rigorous financial review. And it makes for a bit of a lengthy sales process. Again, we're not selling a product, we're selling an approach. It's more of a consultative way of doing things. But we will collect all their financial information. At this stage, we're typically working very closely with their accountant, and we will collect financial statements, balance sheets, cash flows. We will take a look at wills, powers of attorney, insurance policies. We're really trying to get a full snapshot of how the family's structured today and what their cash flows are looking like. That could probably take us a few weeks with a few meetings going back and forth with the clients to collect all that information. Through that time, we're then doing step 3 of this, which we call an attitudinal risk assessment. Gary and our CIO, Greg Roger, actually developed a proprietary psychologically based profiling system many years ago. And we actually use it within Highview, and it's been fantastic for us to be able to understand the emotional makeup of a family in terms of what their real tolerance for risk is. And I know you've probably seen a lot of those little tick sheets that you fill out. It kind of pops out an answer for you. Ours is a lot more complex than that. But at the end of the day, what you're really trying to do is find out what their wiring is to be able to tolerate risk, because everyone's different. And I always find it interesting when you're sitting down with a husband and wife that they're not the same. And a lot of times I find that the men are typically overstating what their real risk tolerance is, because the wife will say, well, you're not that aggressive, you've never been that aggressive. But our job is to sort of flush that out with the families, because you need to get the goals, you need to find out where they sit, but really importantly, especially in environments like we're in now, you need to understand what people's tolerance for risk is, and not just in percentages and dollars. So if I have a $5 billion portfolio, and that goes down by 10%, people go, well, 10% is not that bad. The rest of the world's off, say 25, 30, whatever the number is. But 10% off $5 million is obviously $500,000. Like, that's a lot of money for a family that's just gone down. So if you can't peg what their tolerance is, this is where you typically, in our experience, run into challenges. And at the end, all that fits into an actual wealth plan. And there's a lot of planning software out there today that we've seen in our past where they come out with these beautiful, like 50, 75-page plans that I don't think people really spend much time reading. A lot of our experience ends up in the garbage can. But what we do is put together a proprietary approach that we did where you're really looking at forecasts around cash flows and balance sheets over time. Because when you're dealing with these families, again, they're like mini wealth management businesses, you need to be able to forecast over 5, 10 years. And again, the further you get in the time, the more inaccurate it's going to be, but you're trying to get a direction. But if you can't flow what things look like over time for these families, you're not going to be able to do the proper planning. There could be a huge estate liability when they die. And if you haven't done this type of work, you're going to miss that, and then you're going to have an upset client down the road. So I just wanted to go through this briefly because it's a really powerful upfront process that allows us to build trust and confidence with the clients and their advisors very quickly. But now we can move to the next phase, which is the management of the assets, which then makes the process even stickier over time. So goals-based portfolios, a bit of a newer concept, I would say, over the past probably 5 to 10 years in the private wealth world. Although it's interesting, having come out of the trust business for many years ago, it's the way that trust companies actually ran money 50 years ago. So we're kind of coming back, but it's been a big institutional concept for many years. But we've been using this approach, and the idea is that so much of this industry is around, well, am I beating the markets? Well, families don't really care at the end of the day. What matters to them is, am I meeting my funding obligations? So if they have a lifestyle funding obligation of, say, $500,000 a year in cash flow in their portfolio, and we can only give them like $300,000, but they beat the Toronto Stock Exchange, like, they're not going to be happy. And so it's not that we don't monitor the relative performance, we do, but what's much more important to us is the effectiveness of the money management, which is the absolute goals, versus the efficiency of the relative returns. So we have a number of clients where we can have different goals-based portfolios. We can have one for the lifestyle, one for the philanthropy, and one for even family legacy. It just depends. Everything's a tailored approach. Another key attribute of us is in terms of how we've structured the operational side of the business. Don't want to go into a lot of detail about it, but I wanted to show you this picture because I think it captures the essence of what we're doing. So much of where the world has gone, especially in Canada over the past probably 10 to 15 years, with consolidation is that a lot of the large wealth management firms, they run all these functions. So there's somebody in the organization that's the advisor, someone's doing the proprietary money management, someone's doing the trading, someone's doing the custody. And that's fine, but for this type of segment, if you really want to get the full balance sheet of these families, you need to have a slightly different approach in our opinion. And so we've just divided up the pieces. So Highview is obviously providing the advice part. We're at the top. The investment managers are the sub-advisors that we would hire, and we have about 10 mandates today with kind of call it one manager per mandate. We have both public market and private market solutions we put to clients, but they're combined into a portfolio. But we have gone out and due diligence to specific manager, and we monitor them very tightly for each of the mandates that we have. But they're doing their part, and then they trade to the brokers that they think is appropriate for their type of mandate. And then finally, all the assets sit with a separate custodian, which for us, for the larger families, is actually going to be a trust company. Because in our opinion, that is a true fiduciary-based trust company custodian. And so if the world goes to hell in a handbasket, and again, an extreme example, but those families can walk in and be able to ask the trust company to print off their certificates on their bonds or stocks or other holdings and take it away because it's a pure safekeeping arrangement. And so that model sits really, really well with the families once they understand it. The other piece we have is insurance. And again, we're not out there selling insurance. That's not what our business is. But from a CIO's perspective, being able to use insurance as an off-balance sheet tool to help these families manage risk and return is very, very powerful. We do a lot of plain and simple stuff, a lot of turn to 100 permanent policies, like whole life, par policies, things like that. We don't get into a lot of the many esoteric products that are out there today from the insurance companies, but it's a fantastic tool that can help you manage different components of the family wealth plan. It could be tied to paying estate taxes down the road. A lot of cases when I talk about family legacy, a lot of families, they may have, say, 3 or 4 kids, and the way the estate's going to be carved up, it doesn't necessarily play out the way that the parents have necessarily ideally desired. And so insurance can help fill that gap. So I just wanted to mention it because it's a very, very good complementary tool for us to use with these families. Now the last part, we call it stewardship or the family governance. And this is something that Garrett and I have been really big on, and it comes back again to this concept to talk about these wealthy families or mini wealth management firms. And so the governance that sits around the wealth is very, very key. And a big part of this is that you have to be working with these families with their other advisors. I've mentioned the accountants, they're essential to all this stuff. But the other ones, you have to be working with the estate and trust lawyers. I don't know how many times we've seen in the past where you have families worth millions of dollars and they have wills and powers of attorney that have been updated in 25 years. Matter of fact, I had one client that's still with us after many years, but they had written their first will and power of attorney around the kitchen table with their lawyer when they first started the company. The kids were all grown up, they not updated it. And so things like that, you want to be working with the professionals, it's really key. But we collaborate very strongly with the professionals, so it's almost like you're running a little mini governance board for this little mini wealth management firm. And that's the key of tying in with these professionals. They could be accountants, lawyers. The other ones we see a lot with the wealthy families that have been entrepreneurs is individual pension plans. We have a number of what we call IPPs on the books today, which are $1 million to $2 million. And that's just one slice of the pie. But you need to be working with the actuaries and all these other professionals to pull all this together. I had one family, again, still with us today, that was actually in Oakville. They lived Oakville their whole life. They had their accountant, they had their lawyer. They were probably no more than 5 kilometers away from each other in town. They had never actually met, and they never actually even talked. So if you're running a business, a widget company, and your CFO isn't chatting with your chief technology officer or marketing person, like you're not going to get the best impact for your business. And it's the same with running money for these families. The collaboration and the governance is huge. Now, is that work for families that maybe have $1 million to $2 million? No, it's overkill. But when you get families with net worths of 10 and up, it's critical to put this type of process in place in our view. I want to talk a little bit about the wealth succession, because this is something I think that is going to become very big in this country. Again, for this segment in the coming years, it's certainly been huge in the United States and Europe. And I think we've probably all heard of the phrase of, clogs to clogs in 3 generations, or shirt sleeve to shirt sleeves. And it's a behavioral phenomenon around the world. It doesn't matter what culture it is. And what typically happens, you get the first generation that has that entrepreneurial spirit. They build the wealth for the family. But the kids often, they haven't been necessarily raised the right way. They have a bit of let's call it a financially privileged life. And they might not have the talents that the parents had. And so by the time you get to generation 2, they're now living off the money that the parents built. And then if you're not careful, you get into generation 3, and now we go into depletion mode, because the grandkids really didn't understand what grandma and grandpa went through to build a company. And so part of our role, and I think the people in this industry that operate in this segment are going to have to start to tackle, is how do you help these families maintain the sustainability over generations? Because behaviorally, it can disappear really, really quickly. So I just want to give you a quick client story. This is actually a client that I deal with from the early days of Highview, actually. Wonderful family. We deal with all 3 generations. And he came to us actually through his accountant, and had built up this wonderful business that had a liquidity event for. And they were just scrambled. They had all this confused advice. It wasn't integrated. They had assets, and they had everything all over the place. And so he came, and the first thing he said to us, he says, look, I'm trying to find somebody that can help me so this thing can last for many generations. And we actually had the kids in the room when he was talking about this, and it was so important for him. He actually said to the kids, once we get this in place, if you kids screw this up and blow this money, he says, I'm going to come back and haunt you for the rest of your lives. But this is what's on their mind. And this has nothing to do with beating the stock market. This is all about the behaviors within the family. So again, when they came to us, we had stuff all over the place. I can still remember getting the emails late at night where he'd scan different information. We must have had 10 different financial institutions, pockets all over the place. It typically, for these families, the first 9 to 12 months for us, I call as a bit of a cleanup. They've not been getting typically the proper servicing in the industry. And so we go through a cleanup mode where we're really getting things now lined up against the goals that we established with the family. It tends to be a little bit front-ended. There's a lot of meetings the first year for sure. But once you have it set up, it becomes a very predictable process with pre-scheduled review meetings with families and their accountants where needed. And it starts to run really well, like you would have like a well-run business. And so that's what we went with this family. And after a decade with them now, they're incredibly happy. They've been a great referrer of additional entrepreneurial families that they know to Highview. And they have the sustainability of the money. I interact with the parents, we work with the kids, and they now have 7 grandchildren. And the grandchildren are all minors. So it's not like we're having conversations with them, but I expect that they will be clients of ours in another 10 years, and we're going to be dealing with the kids directly now when the parents pass on, and even longer term with the grandchildren. And that, at the end of the day, that is the stuff that gives them comfort. And this client was actually the one that said, you don't know Highview until you experience Highview. And that's left a lasting impression with us. So, that's the Highview story. I thank you for your time, and are we opening up for questions if people have any? Liz? Yeah, great. Yes?
Do I have to grab a microphone? Yes.
Yeah.
Thanks, Mark. You touched on this somewhat, but I'd like to understand what kind of stickiness you actually have with the kids in terms of staying with Highview. And what are your strategies to make sure that these kids, or I guess we should call them young adults, or this newer generation, stays with you? It sort of sounded like it was automatic or implicit, but I'm wondering if you do ever see some exit, and therefore, what you do to try to contain that.
Yeah, that's a great question, Beth. The stickiness is just as high as we have with mom and dad. And I get a lot of questions over time with this where people say, well, they're millennials as an example, right? And so like, wouldn't they be into doing their own stuff and crypto and a few years ago, cannabis and all this stuff? And the conversations for certain come up, and there may be very small elements of the portfolios that the kids will allocate to that stuff, but generally, and this is the work we've done up front, is involving the kid in the overall wealth process with the family at the right time allows them to start to understand how this thing needs to work to make the money sustainable, because aggressive strategies like crypto and cannabis and things, not to say you can't do a bit of them, but they can lead you down pretty bad paths if you're betting your entire balance sheet on it. And so we run it that way, and they just start to appreciate the process. Yeah. Yes. Oh.
So you had mentioned that you've been adding assets in the past year, and obviously,
Correct.
Depending on the day, the S&P is down 20-25%. So what dynamics do you think are really driving the net flows in your business?
Good question. A couple things. One is, I think, when we work very closely with a number of accountants. And so we've had those relationships for many years. So they know us very well, they know how we work, and they're great referrers for us. And so right now in this environment is awesome for us because there's so much collateral damage that's going on in the industry, not just in Canada, but globally. And so there's balance sheets that have just been, gone down a lot, or some cases even wrecked. And so the accountants go, like, if you don't want to live that life anymore, like, you got to talk to Highview. Because right now in this environment, if I remove the impacts of money's in, money's out from clients, our portfolio's down, depending on the day. Right now, we're probably down about 9 to 10%. But we still have cash flow coming in the portfolio that would be sort of in the 4.5 to 5% range. So that gives people a ton of comfort and confidence that they at least want to have a conversation. And then we run them through that process, and they go, I've never had this conversation with anybody. This is awesome. Let's move all my money over. That's kind of how it works. Yeah. Yes?
Hi. Great presentation, by the way.
Oh, thank you.
Very impressive. I wanted to ask you, you mentioned something, and perhaps I misunderstood, but you said you partner with your clients. They become owners in the company. Like, how does that work?
Oh, I'm sorry. It's not a legal partnership. I call it partnering. Like, we will partner with their professional advisors, like their accountants and their lawyers. And like a prime example, like I had one of these meetings back last month, actually with this family. So we had mom and dad, we had one of the kids, a couple of the other kids couldn't make it. We had the accountant there who's always at the meetings. They have a very tight relationship with the accountant. And we were talking through a whole bunch of financial, like once we got through the portfolio review part, most of the conversations have nothing to do with actually the money management. It's all these other softer issues that sit around the families. And so it's that partnering approach that they like, because it's almost like a virtual board you're creating. And it comes back to that outsourced CIO concept that you can't afford to bring everybody in-house. So you do a virtual partnering with them on an outsourced basis. So you give them the same output, but I think in a far more objective and transparent way.
Okay, thank you.
I have a minute, okay.
Wealth management is a very cash flow sort of predictable business. There's ongoing revenues that come in, and I'm just wondering, why do you need Urbana's capital? What do you do with it that is that requires external capital for your company?
Yeah, good question. So it's not a current today thing. It was more of a past thing, but to build this type of business like you would see in the States, which is more like these RIA firms, there's a lot of upfront costs because you're starting with asset zero on day one. And you have to at least start to attract some people. Like, we haven't done a massive front end build like you see some firms doing, which are more retail, where they're going out recruiting a whole ton of advisors. But there's that, and the technology, the regulatory costs, there's a front end amount you have to do until you get to that cash flow positive stage.